We're in the spring of 1964, and if you walked into any brokerage firm on Wall Street, you'd hear the same advice repeated like gospel: buy the Nifty 50. These were the 50 greatest companies in America. Stocks so good you could buy them and never sell. Or so they said. Companies like Polaroid, Xerox, Kodak, companies that seemed invincible. The smartest investors in the world were pouring everything into these 50 names because diversification felt unnecessary when you owned the best of the best. By the end of this video, you'll understand the exact mechanism that financial institutions use to keep your wealth concentrated in ways that benefit them, not you, and how the decisions you make after hitting $100,000 determine whether you're building real wealth or just padding someone else's returns. Let me tell you what happened next in 1964. My name is David, and I spend way too much time thinking about money and psychology. If you're someone who's tired of generic financial advice that sounds good but doesn't actually build wealth, subscribe and like this video. It will help more than you think. So back to Wall Street in the 60s. These Nifty 50 stocks weren't just popular. They were trading at price to earnings ratios of 40, 50, even 60 times earnings. Polaroid hit a PE ratio of 90. 90. That means investors were paying $90 for every $1 of profit the company made. Why? Because everyone believed these companies would grow forever. They were called one-decision stocks. You make the decision to buy, and you never need to decide again. Pension funds loaded up. Individual investors mortgaged their futures on these names. Assets poured in, and the concentration became extreme. By 1972, institutional investors had roughly 70% of their equity holdings in these 50 companies. 70% of trillions of dollars, all in 50 names. But here's the catch. When everyone believes the same thing, when capital concentrates that heavily, the math stops working. The Nifty 50 weren't bad companies. They were great companies, but they were priced for perfection, and perfection is expensive. Then came 1973, oil crisis. Inflation spiked, the economy stumbled, and suddenly investors realized that paying 90 times earnings for Polaroid assumed flawless execution forever. Reality is messier. Polaroid dropped 91% from peak to trough. Xerox fell 71%. Even companies that survived and thrived later, like McDonald's and Disney, lost more than 60% of their value. The index of these 50 stocks, the safest bet in America, collapsed. In less than 2 years, investors lost approximately $300 billion in market value. Pension funds that had concentrated 70% of their equity in these 50 names faced catastrophic losses. The people who built those portfolios, the supposed experts, they kept their jobs. The retirees, depending on those pensions, they paid the price. And here's the kicker. The brokers who sold these stocks, the mutual funds that charged fees to manage these concentrated portfolios, they collected their fees the entire way down. They didn't lose. You did. So what does this have to do with hitting $100,000 in net worth? Everything. Because the same pattern is happening right now, just with different names. The moment you cross $100,000, you enter a phase where financial institutions want you to concentrate your bets in ways that generate fees for them and risk for you. They'll sell you on the idea that index funds are safe because they're diversified. And sure, the S&P 500 holds 500 companies, but here's what they don't tell you. The top 10 companies in the S&P 500 now represent over 30% of the index. 30%. Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla. 7 companies dominate. If you think you're diversified because you own an S&P 500 index fund, you're not. You're heavily concentrated in 7 mega-cap tech stocks, and you're paying for the illusion of diversification. Now you might be thinking, but David, these are great companies. They are. So were Polaroid and Xerox. The issue isn't quality, it's valuation and concentration. When 30% of your portfolio rides on 7 companies, and those companies are priced at 30, 40, 50 times earnings, you're making the same bet investors made in 1972. You're assuming perfection. Let me give you an everyday analogy. Imagine you own a restaurant and your menu has 50 items on it. Sounds diverse, right? But then you look at the numbers and realize that 7 items generate 70% of your revenue. Burgers, fries, chicken wings, pizza, tacos, salads, and pasta. Those 7 dishes are your moneymakers. Everything else barely moves. You feel good because revenue is high. Customers love those 7 items. But then food trends shift. Keto takes off, and suddenly burgers, fries, and pasta fall out of favor. Plant-based becomes the norm, and your chicken wings don't fit. Within 6 months, 70% of your revenue evaporates. You still have rent, staff, inventory costs for all 50 menu items, but the dishes people actually bought are now sitting untouched. You're not just less profitable, you're bankrupt. That's concentration risk. It doesn't matter if you have 50 items on the menu if 7 items drive all the results. When those 7 fail, the whole business collapses. Your index fund is that restaurant. You own 500 stocks, but 7 of them drive the majority of your returns. If those 7 stumble, your portfolio craters, and you're left holding 493 stocks that aren't pulling their weight. This is where it gets really interesting. Who benefits from you staying concentrated? The financial institutions. When you pour money into index funds, asset managers collect fees on the total assets under management. The more money you invest, the more they make, regardless of your returns. Vanguard, BlackRock, Fidelity, they manage trillions. Trillions. They don't care if the S&P 500 is overvalued or if concentration risk is extreme. They collect their basis points every single year, whether the market goes up, down, or sideways. And here's the method they use to keep you invested. They publish studies showing that active management underperforms passive indexing. And statistically, that's true for most active managers. But what they don't emphasize is that passive indexing works best in broadly diversified markets with reasonable valuations. When markets are concentrated and expensive, passive indexing becomes passive concentration into overvalued names. But they won't tell you to pull back or diversify differently because that would mean lower assets under management and lower fees for them. They also use something called recency bias against you. The S&P 500 has delivered incredible returns over the past 15 years, driven largely by those 7 mega-cap tech stocks. Every chart they show you starts in 2009, right after the financial crisis, making it look like index investing is a one-way ticket to wealth. What they don't show you is what happened in the 2000s when the S&P 500 delivered negative returns for a decade, or what happened in the 70s when it went nowhere for 10 years. Or what happened to the Nifty 50. They know you anchor to recent performance, so they keep feeding you data that shows the last 15 years and imply that the next 15 will look the same. So what's the move? What should you do today if you've hit $100,000 and you're sitting in a standard S&P 500 index fund? Here's your first action step. Audit your actual concentration. Log into your brokerage account right now and look at your holdings. If you own the S&P 500 or a total stock market fund, check the top 10 holdings. Add up the percentage of your portfolio that sits in those 10 names. If it's over 25%, you're concentrated, not diversified. Then ask yourself, do I believe Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla will all continue growing at their current pace for the next 10 years without a major correction? If the answer is anything other than absolute certainty, you need to adjust. Here's what that adjustment looks like. You don't abandon index funds entirely. They're still a powerful tool, but you add balance. Consider equal weight index funds instead of market cap weighted funds. An equal weight S&P 500 fund owns the same 500 companies, but it allocates equally to each, so no single company dominates. That reduces concentration risk immediately. You can also diversify across asset classes, add exposure to international stocks, which are currently cheaper than US stocks by almost every valuation metric. Add real estate investment trusts, which provide exposure to income-producing property. Add commodities or treasury inflation-protected securities to hedge against inflation and economic volatility. The goal is not to abandon equities. It's to stop pretending that owning one index fund equals diversification when 30% of that fund sits in 7 stocks. But now you might think, David, if I diversify away from the S&P 500, won't I miss out on gains if those 7 stocks keep running? Maybe. But here's the thing. Wealth building after $100,000 isn't about maximizing every possible gain. It's about maximizing risk-adjusted returns. It's about avoiding catastrophic losses that set you back years. If you hit $100,000 and you lose 50% in a market crash because you were concentrated, you're back to $50,000. Now you need 100% returns just to get back to where you were. That's years of compounding lost. If instead, you accept slightly lower returns in exchange for lower risk, you avoid the catastrophic drawdowns, and you keep compounding smoothly. Over 10, 20, 30 years, that smooth compounding beats volatile boom and bust cycles almost every time. Let's talk about decision number 2. After you hit $100,000, you need to stop thinking like a saver and start thinking like a capital allocator. Below $100,000, your biggest lever is your savings rate. If you make $60,000 a year and you save 20%, that's $12,000 a year. If you increase that to 30%, that's $18,000. The difference, $6,000, is meaningful. But after $100,000, your returns start mattering more than your contributions. At $100,000 invested at 8%, your portfolio grows by $8,000 in year 1 without you adding a dime. If you're contributing $12,000 and earning $8,000 in returns, your returns are already generating 40% of your annual wealth increase. By the time you hit $200,000, that flips. Returns outpace contributions. At $500,000, returns dwarf contributions. This is why asset allocation becomes critical. The difference between earning 6% and earning 10% on $100,000 is $4,000 a year. Over 10 years, at 10%, $100,000 becomes $259,000. At 6%, it becomes $179,000. That's an $80,000 difference just from allocation decisions. Most people never make this mental shift. They keep obsessing over whether to save an extra $100 a month while ignoring the fact that their allocation is costing them thousands. Now you're asking yourself, how do I become a better capital allocator? Start by understanding the risk and return profile of different assets. Equities historically return 8 to 10%, but with high volatility. Bonds return 3 to 5% with lower volatility. Real estate returns 6 to 9% with moderate volatility and inflation protection. Commodities are volatile but hedge inflation. Cash returns nothing but provides liquidity and safety. A good capital allocator doesn't just dump everything into equities and hope. They build a portfolio that balances growth, income, and protection based on their timeline and goals. Let's get specific. If you're 35 years old with $100,000 and a goal of reaching 1 million by 50, you have 15 years. You can afford to take risk, but you also want to avoid major setbacks. A reasonable allocation might be 60% equities diversified across US, international, and equal weight funds, 20% real estate through REITs, 10% bonds for stability, and 10% in a high-yield savings account for liquidity. That allocation gives you growth, diversification, income, and a cash cushion. As you age or as your wealth grows, you adjust. Maybe at $500,000, you shift to 50% equities, 30% real estate, 20% bonds, because you have more to protect. The point is, you're making intentional decisions based on math and goals, not just following the default advice to dump everything into the S&P 500. Decision number 3, optimize your tax efficiency. This is where most people leave tens of thousands of dollars on the table. Below $100,000, taxes matter, but the amounts are small. After $100,000, tax inefficiency becomes expensive. If you're earning $8,000 a year in returns and you're paying 30% in taxes because everything is in a taxable brokerage account, you're losing $2,400 annually. Over 10 years, That's $24,000 plus the compound growth you would have earned on that money. It's a massive leak. Here's what tax optimization looks like. First, max out all tax-advantaged accounts. 401k, IRA, HSA, 529 if you have kids. These accounts either defer taxes, eliminate taxes, or both. A 401k lets you contribute up to $23,000 a year pre-tax as of 2024. That reduces your taxable income now, and the money grows tax-deferred until retirement. A Roth IRA lets you contribute $6,500 a year after tax, but the growth is tax-free forever. An HSA lets you contribute $4,150 for individuals, $8,300 for families, and it's triple tax advantaged. Contributions are tax deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. If you're not maxing these accounts, you're paying unnecessary taxes. Second, be strategic about asset location. High growth assets like stocks belong in Roth accounts where the gains are tax-free. Income generating assets like bonds or REITs belong in traditional IRAs or 401ks where the income is tax deferred. Taxable accounts should hold tax-efficient assets like index funds that don't generate much taxable income annually. Most people do the opposite. They put bonds in taxable accounts and stocks in traditional IRAs, which maximizes their tax bill. Third, use tax loss harvesting. If you hold individual stocks or ETFs in a taxable account and one of them drops in value, sell it, realize the loss, and buy a similar but not identical investment. The loss offsets gains elsewhere in your portfolio, reducing your tax bill. You can harvest up to $3,000 in losses per year to offset ordinary income, and any excess carries forward to future years. This is free money, but most people never do it. Look, the IRS isn't your enemy, but they're not going to optimize your taxes for you. Every dollar you save in taxes is a dollar that compounds for you instead of going to the government. After $100,000, tax efficiency isn't optional. It's a requirement. Decision number 4, eliminate all high interest debt, period. If you have credit card debt, personal loans, or car loans at rates above 6 or 7%, paying those off is a guaranteed return that beats almost any investment. If you have $10,000 in credit card debt at 18% interest, that debt is costing you $1,800 a year. Paying it off is an 18% return, risk-free. You can't beat that in the market. I know the math says you should invest instead of paying off low-interest debt, and in theory, that's correct. If you have a car loan at 4% and you can earn 8% investing, you're better off investing. But here's the psychological reality. Debt is a mental drain. It's a monthly obligation that reduces your flexibility and increases your stress. After $100,000, your goal should be financial freedom, and freedom means eliminating obligations. Pay off everything above 6% immediately. Then decide on a case-by-case basis for lower rate debt. If you have a mortgage at 3%, keep it and invest the difference. If you have a car loan at 5%, maybe pay it off for the psychological win. The point is, high interest debt is a wealth killer. And after $100,000, you have the resources to eliminate it. Do it. Decision number 5, and this is critical, increase your income. Most personal finance advice focuses exclusively on cutting expenses and saving more. That's important early on, but after $100,000, your income becomes the biggest lever. If you're making $60,000 a year and saving 20%, you're adding $12,000 annually. If you increase your income to $90,000 and maintain that 20% savings rate, you're now adding $18,000 annually. That's a 50% increase in your wealth building speed without cutting a single expense. Here's the truth. Cutting expenses has a floor. You can only cut so much before you hit basic living costs. But income has no ceiling. You can always earn more. The question is, are you actively working to increase your earning power, or are you passively accepting your current income as fixed? After $100,000, you should be investing in skills, certifications, side businesses, or career moves that increase your income. Take a course that makes you more valuable at work. Learn a high-income skill like sales, marketing, or coding. Start a side business that generates an extra $1,000 or $2,000 a month. Negotiate a raise or switch jobs for a 20% pay bump. I'm not saying become a workaholic. I'm saying recognize that at this stage, your human capital, your ability to earn, is your biggest asset. $100,000 invested at 8% grows to $215,000 in 10 years. But if you increase your income by $30,000 a year and invest that extra income, you add $300,000 over 10 years plus growth. Your income is the engine. Your investments are the compounding machine. Both matter. Decision number 6, build a cash reserve that's larger than the standard advice. Most financial gurus tell you to keep 3 to 6 months of expenses in an emergency fund. After $100,000, that's not enough. Here's why. 3 to 6 months covers short-term emergencies like a job loss or medical expense. But after $100,000, you face different risks. Market downturns that last years, opportunities that require capital, major life transitions like starting a business or taking a sabbatical. A small emergency fund doesn't cover those. Instead, build a 12 to 18-month cash reserve. I know that sounds like a lot. I know it feels like you're sacrificing returns by holding cash, but cash is optionality. It's the ability to take risks without jeopardizing your financial stability. If the market crashes 50% and you have 18 months of expenses in cash, you don't panic sell. You wait. You maybe even buy more at lower prices. If a business opportunity comes up and you need $20,000 to invest, you have it. If you want to take 6 months off to travel or retrain for a new career, you can. Cash is freedom. And here's the thing. The opportunity cost of holding cash is lower than you think. If you keep $50,000 in a high-yield savings account earning 4%, that's $2,000 a year. If you invested it at 8%, you'd earn $4,000. You're giving up $2,000 annually. But that $2,000 buys you peace of mind, flexibility, and the ability to act when others can't. That's worth it. Decision number 7, stop paying for financial advice you don't need. After $100,000, financial advisors start circling. They'll tell you that your finances are getting complex and you need professional help. Sometimes that's true. Most of the time, it's not. The average financial advisor charges 1% of assets under management on $100,000. That's $1,000 a year. On $500,000, it's $5,000 a year. Over 20 years, those fees compound into hundreds of thousands of dollars in lost wealth. What do you get for that fee? Most advisors put you in a standard portfolio of index funds and bonds, rebalance once a year, and send you a quarterly statement. You can do that yourself in 30 minutes. If you need specific help, like tax planning, estate planning, or insurance analysis, hire a fee-only advisor who charges by the hour. Pay them $500 or $1,000 for a comprehensive plan, then execute it yourself. Don't pay 1% annually for something you can manage on your own. Now, if you have complex needs, multiple businesses, significant real estate holdings, or you're in a high tax bracket with intricate tax strategies, a good advisor might be worth it. But for most people with $100,000 to $500,000 in straightforward index fund portfolios, you're paying for handholding, not expertise. Save the fees and invest them. Decision number 8, invest in asymmetric opportunities. This is where wealth acceleration happens. An asymmetric opportunity is one where your downside is limited, but your upside is massive. Think of it like this. You invest $5,000 in a calculated risk. If it fails, you lose $5,000. If it succeeds, you make $50,000 or more. That's a 10-to-1 upside. Most people avoid these opportunities because they focus on the risk of losing $5,000. But after $100,000, you can afford to take small, smart risks that could massively accelerate your wealth. What does this look like? Maybe you invest $10,000 in a friend's business where you believe in the product and the person. If it fails, you lose $10,000. If it succeeds, you could double or triple your money. Maybe you buy a small rental property in an emerging neighborhood. If the area doesn't appreciate, you still collect rent and break even. If it does appreciate, you make significant equity gains. Maybe you invest in yourself by starting a side business with low overhead. If it doesn't work, you lose a few $1,000s and some time. If it works, you build an income stream that generates tens of thousands annually. The key is that these are calculated risks, not gambles. You're not buying lottery tickets. You're identifying opportunities where you have insight, control, or an edge, and where the risk-reward ratio is heavily skewed in your favor. After $100,000, allocating 5 to 10% of your net worth to asymmetric bets can be the difference between steady growth and exponential growth. Decision number 9, automate everything. After $100,000, your finances should run on autopilot. Every paycheck, money should automatically flow to your 401k, IRA, brokerage account, savings account, and bill payments without you thinking about it. Why? Because decision fatigue is real. Every time you manually decide whether to invest, save, or spend, you introduce the possibility of making the wrong choice. Automating removes that. Set up automatic contributions to your retirement accounts. Set up automatic transfers to your brokerage for taxable investing. Set up automatic bill pay so you never miss a payment. The result is that your wealth builds in the background while you focus on earning more, learning more, and living your life. The people who build serious wealth don't agonize over every financial decision. They set up systems that make the right decisions automatic. Then they focus their mental energy on bigger levers like increasing income or finding new opportunities. Decision number 10, and this is the one that ties everything together. Shift your identity from someone who has money to someone who builds wealth. There's a massive difference. Having money means you've accumulated a number in an account. Building wealth means you've developed the skills, habits, and mindset to grow that number consistently over time. Most people who hit 100,000 celebrate, then plateau. They stop learning. They stop optimizing. They coast. And 5 years later, they're at 150,000 when they should be at 300,000. The people who multiply their wealth treat 100,000 as the beginning, not the destination. They read books on investing, taxes, business, and psychology. They listen to podcasts. They study the strategies of people who've built the wealth they want. They experiment, fail, learn, and improve. They view wealth building as a skill to master, not a milestone to check off. Here's the brutal truth. $100,000 is a great achievement, but it's not enough to retire on. It's not enough to provide long-term security. It's not enough to create generational wealth. It's a foundation. What you do next determines whether that foundation supports a modest house or a skyscraper. The decisions I've outlined today, recognizing the shift to acceleration mode, auditing your concentration, thinking like a capital allocator, optimizing taxes, eliminating high-interest debt, increasing income, building a larger cash reserve, avoiding unnecessary fees, taking asymmetric risks, automating your systems, and shifting your identity. These are the decisions that separate people who plateau at 200,000 from people who hit 1 million and beyond. You've done the hard part. You've proven you can save, invest, and delay gratification. Now it's time to level up. Make these decisions, execute them consistently, and watch your wealth compound faster